So hi, Jeffrey. Thank you very much for coming along to this little webinar. And it's everything you need to know about buying a home. I'm Susan Eckersley. I'm a realtor with Real Estate Homeward, and with me is Jeffrey Kiusis, a mortgage broker with Pineapple.
Thanks for having me, Susan. It's a pleasure.
You're very welcome. Some folks seem to do their own pre-approval, figuring, okay, 40% of their income is what they can afford to qualify for, and off they go, seem to run, that they can do everything. So what should be a buyer's top financial priority? And would that be different from a seller's view or a buyer's view?
Well, absolutely, it would be different from a seller's view compared to a buyer's view. Different goals and different motives in mind for both. When you're looking to purchase, I mean, first and foremost, your quality of life is what you should be focusing on. And going through the motions of figuring out what you can get approved for is an important part of what you're looking to accomplish. Although guidelines would put us at 39% of household income being apportioned for qualification, there are alternative lenders that would extend out further. The question arises is, what is that income taken away from? So if you're spending more on your mortgage, what are you losing out on? So those are important questions for a buyer to ask themselves in determining how much they're willing to give of their income in order to sustain their home alone, because there's more expenses other than a home. And of course, as a seller's point of view, a seller's target is always going to be to try to get as much money as possible when selling their home. So obviously speaking, they want to find the right buyer who's given them the right price in order to make that happen.
Okay. That's great. Thank you for that question. Why is it important then to get pre-approved?
It's important to get pre-approved just so that way you are able to determine if the purchase you're looking to complete is a viable option. The most important thing to remember is just because you make or you deposit, let's say, $100,000 into your bank account as your annual salary, it doesn't mean that the lender is going to see it in the same perspective. So understanding how your income is going to be calculated, what can be used, what can't be used, is an important part of determining where things can land. Nothing would be worse than having somebody who's, for example, is self-employed and declares only $20,000 in income to CRA, but actually makes $100,000, realizing that, oh my God, I'm using the wrong number to calculate what I can qualify for. So it's important to get a lot of those questions answered beforehand, so you know where things will stand when you can when you're ready to actually close.
Thank you. And what is pre-approval versus pre-qualified?
So a pre-qualification is basically a high-level conversation that can occur where we would go through several different points involving what the person's job entails, their income qualifications, the property that they're anticipating to actually put an offer in on, for example, as well as credit history verbally discussed. Whereas a pre-approval is more in-depth, although you still have that high level of conversation, we would be also collecting documents at this point. So we'd be asking for pay stubs, job letters, T4s, just to validate everything that we're going to be putting forward on an application. Generally, there's also a credit check at this point as well, too, also to make sure that there's no surprises going forward. But the main difference between the pre-qualification and the pre-approval is there's actual hard copy facts that are supporting an application that we're preparing to submit forward. Whereas a pre-qualification is just a high-level conversation outlining what's happening.
Great. Perfect. Thank you. So if the buyer is pre-approved, does that mean he's okay to go out and buy a home, or are there any more steps they need to take?
Well, if they've done a full pre-approval, generally speaking, we have a great idea as to where we can take this. A responsible broker would also have conversations with lenders. If there are any question marks that remain outstanding, we should have answers to all those questions before anything is put in place. Up until that point there, I mean, the borrower is pretty much qualified. We would be able to get an approval based on the information that we've discussed. The only question mark then is the property that they are looking to purchase, which of course is always coming into question to make sure that the price is right, to make sure that the value is there, down payment is settled as well too. So then that way, of course, there are no surprises on either the front end when they're actually finding a home, or the pre-qualification level, which is the back stuff that they've done a little while before making that offer.
Great, great, great. Thank you. Now, I know some people get confused over the gross debt service and total debt service. And I say, just remember the gross is the G for the ground. So everything that is on a roof and down below is covered by that figure. So sort of taxes, mortgage, interest, and heating costs, of course.
Sure.
And then TDS is all of the above, plus credit card, car loans, and student loans.
For sure, yeah.
And all of that should not be greater than 42%. Is that correct?
So it's roughly around there. I mean, we use that as a safe guideline, just in case, because there's always little surprises as to how debts are calculated.
Right.
You were correct in the calculation for the gross debt servicing ratio. That is definitely what it would include. One thing to add to that, it does not include home insurance, which is a mandatory facet of every mortgage, but it's not mandatory to include that in there. With the TDS as well too, if you have great credit, lenders would extend out as far as 44%. If you have mediocre credit, we would be at the 42% like we're suggesting here as well too. So there are possibilities to stretch it out further. Now, the TDS includes all reporting debts that are on file, from student loans to car loans, to also balances that possibly are not used. So for example, if a homeowner owns if a homeowner is looking to purchase another home and they have a home equity line of credit with a balance of $0 on it, it's still something that we need to take in consideration when calculating our ratios to submit for a new purchase, for example.
Very good. Very good. Thank you. And how flexible are the underwriters for this part of the approval, if any?
So again, it depends on the scenario. I'm not going to say that there is not flexibility out there. As long as the story makes sense, it's something that is feasible. So for example, I'll go back to the self-employed person that we discussed at the beginning who declares $20,000 a year, but really makes 100. As long as we can show that there is other income that is coming in, perhaps through a corporation, then it is definitely possible to have some leeway when it comes to lender underwriting. Also, the story that comes into play as well too is something that would need to be addressed and discussed as well too. So for example, I'm due for a raise in the next month. That's definitely something that could be addressed and discussed ahead of time.
Perfect. And the 42% maximum, you already said that it could go up, but it depends on each individual, I guess.
Correct. As long as the story makes sense and the lender is understanding in those scenarios, yes, there have been exceptions even beyond the 44% as well.
Okay. And when I'm talking about house prices increases, I mean, everything seems to be going over asking right now. And house prices have gone up from 2021, and even now they're going up again from January of last year to this year, February of last year to this year. So when house prices are increasing so much, and they've roughly went up 35% each, average over 35% over each month, year over year, how, with so many properties going over asking, how do the banks then appraise a property when it's not sold for asking? So
very good question, actually, because we're starting to see some new things happening in our current landscape as well too. Generally speaking, an appraiser is going to look at properties that have been sold, closed, and transferred to the new owner. They do not take in consideration sales that are in firm closing periods. So they haven't actually legally closed as of yet. So what we're seeing now more and more is that lenders and appraisers are coming in a little bit lower than what's anticipated to be the actual purchase price. And the main reason is the market has not caught up to the fact that things are increasing on such a quick pace.
Yes.
Where this house is going to be closing, let's say, this week, and there's another one closing for a month from now that is 10% over what you paid for. That's the difference that we're seeing accounted for. So a wise discretionary piece of advice that I always give is either target for a longer closing date if possible, to allow the comparables that are seen on the sold portion to close and transfer over, which will allow your appraisal to use that one as a comparable, bringing your value up to where you need it to be. Or be prepared for the offset of having to displace the difference between the appraised value and the purchase price with liquid capital, cash.
Which could be huge.
Again, this is why it's important to speak to not only your realtor about this, but also a mortgage professional to be able to go through the process with you to make sure that you are able to buffer a possible difference if the need is there.
Fair enough. And who pays for this appraisal, and does the buyer get a copy of it?
So generally it is the buyer that pays for the appraisal, and the appraisal works in the fashion where it is actually commissioned and ordered by the lender, and it is property of the lender.
Oh,
So when the appraisal is completed, they will be forwarding it to the actual lender in question and not to the borrower. The reason for that is it's not privy information to them. It is only privy to the actual lender. The main reason for that is, what if you bought a property for $1 million and then your appraisal comes in at $2 million? Nobody's going to say boo about that, because now all of a sudden, what banks want to do in this scenario is just keep you in the category that you originally thought of, a higher loan to value, which dictates a higher interest rate as well too in most scenarios. So with that as well too, you'll end up not having that appraisal provided to you. But generally when you're working with a broker, they will have that appraisal provided by the lender to them direct, and the broker then in those scenarios will share that with you to make sure that everything is on the up and up, and the client is aware of what's transpiring with that. Now, a lot of lenders also offer rebates for appraisals as well too. In that scenario as well, all you would need to do is provide a copy of the receipt to your broker. As long as they've discussed it beforehand and the lender that they're using does offer the rebates, the broker provides that receipt back to the lender, who then rebates the appraisal costs back to the borrower upon closing.
fantastic. And are there any ways that me as an agent could help with the appraisal, or with the buyer can help with the appraisal? Is there any way to assist that?
I mean, more than anything else, I had mentioned with the extended closing. So the main part about this in our current landscape is just aligning what's actually going to be closing in comparison to what's actually already closed with the closing cost, right? So with the closing price, I'm sorry. So you want to make sure that all the comparables that you're utilizing to draw a value on a property are actually closed transactions that have been transferred over, entitled to a new person, which can then be utilized in the appraisal as a comparable. The other aspect of it is just making clients aware of what they need to know in the event of an appraisal coming in a little bit under. And I know, Susan, you're an incredibly honest realtor as well too. So when we're speaking with our clients, I mean, just detailing what we need to actually mitigate in the event of an appraisal coming in under the value that we are anticipating it to come in is an important facet of what we need to do. The other aspect that you might want to consider in those scenarios too, on a financing side, could be a purchase plus improvements. A purchase plus improvements will not only take into consideration the value currently, but also the potential value down the road, whereas a lender is going to be loaning a little bit more than what you would be allowed to borrow, generally speaking, as long as you can qualify for it, to make some upgrades to the home, in which scenario your value of the home has now increased, and then again it's revalidated upon completion and the lender is satisfied with that aspect.
All right, super duper.
Does that make sense, or did I speak a little bit faster?
That's great. No, it's all very, very helpful. And just a few miscellaneous questions then to wrap up, and I do appreciate your time here. What is LTV?
LTV is loan to value. That is the magic number that we're looking at when it comes to down payment. Generally speaking, it's going to range anywhere from 0 up until 95%. That's the portion of the lender's interest in the property. The remaining portion of that percentage is the equity that a current owner or buyer will have in that property. So the minimum down payment would be 5%, which means that loan to value can be as high as 95% in Ontario.
Are there any loans being done with only 5% down now, or is it 10% as the sort of minimum, really?
It's interesting because when you're looking at 5% down, that would be a purchase under $500,000. Yes. After $500,000 up until $1 million, you would need to have 10% of that difference there.
Okay.
So the way loan to value or the down payment would be calculated would be 5% of the first 500,000,
Right.
10% up until $1 million.
Gotcha.
Once you cross the threshold of $1 million, then your mandatory 20% down payment for the total.
Oh, okay, great.
So in Toronto and the GTA in particular, it's rare to see something that can go in with as little as 5% down, just because purchase prices are generally over $500,000.
Yes. Yeah.
But when you're looking in the outskirts of the GTA or other towns in Ontario, there are still properties that are still under $500,000, which are going through with 5% down.
Great. And I have had somebody say, I'm
Oh.
thinking of buying a new car or truck before I buy a house. Is that okay?
So the short answer is absolutely not. No, I mean, you want to just make sure that everything is in line for the home purchase and that you qualify for that aspect. There's no point in rocking the boat in a couple months time span to finance a new car. If you're thinking of buying it in cash and it's not going to affect your credit bureau or your down payment or your ability to buy a new home, then by all means, go ahead and take care of that. But if you're doing any financing and you are looking at purchasing a home, it should not be done. And that's going to also include, oddly enough, I don't know if you're familiar with how furniture stores, they would be saying, don't make a payment for up to 1 year.
Right.
So those are also something that are gimmicks that can actually fumble up a mortgage. I've had surprises come up a few days before closing because purchasing a new home, people are excited. They want to furnish the new home as well too. And what a better way to do it than with a ability to do it without a payment for the first year.
Yeah.
But that's also a debt that pops up that needs to be serviced as well, technically, in their application. And it can really throw a monkey wrench in things.
Good point. Very good point. And I've also heard buyers saying, I'm not very tech savvy, so reading over the internet is not for me.
Again, I mean, there's always alternatives. Meeting in person is definitely one thing. Phone calls definitely are a definite go-to. But the way technology is as of late as well too, it's pretty easy to actually click a link to get into an online meeting. It shouldn't be that difficult for most persons. But now that the pandemic is subsiding as well too, I'm anticipating in-persons to be more of a popular realm again.
Perfect. And apart from a down payment, are there any other buyers monies buyer needs to close the deal?
Yes, so there are closing costs that are associated with every purchase of property in Ontario. So in the province of Ontario, first and foremost, you would be charged a provincial land transfer tax, which is going to vary anywhere from 1% and up, depending on the price of the property. If you're purchasing within the city of Toronto as well too, you would be responsible for the municipal land transfer tax, which would be the equivalent of the provincial land transfer tax as well. Now, as a first-time buyer, you would be entitled to rebates of up to, I believe it's $8,675 total, $4,000 rebate on the provincial land transfer tax, and if I'm not mistaken, it's $3,675 on the municipal land transfer tax, which is applicable to Toronto only.
Right.
Other than that, you'd be responsible for paying for the appraisal upfront, lawyer, title searches, insurance as well too. So those are all costs that are going to be associated with the purchase. And a good rule of thumb is to anticipate having an additional 2.5% of the purchase price set aside ready for closing if you're purchasing within Toronto. If you're purchasing in Ontario but outside of Toronto, then you'd be looking at approximately 1.5% of the purchase price set aside for closing costs.
It's a great rally call for Durham area. Save 1% on your closing costs.
Absolutely. And again, that can be like when you're talking about $1 million property, it could be upwards of $20,000. Right?
Yes, for sure. The Bank of Canada just increased their rates, I believe, yesterday. So now what?
Well, I mean, so the increase that was made recently or yesterday was something that would affect a variable rate mortgage for most mortgages. Okay. So if you're in a variable rate, prime as of yesterday was at 2.45. By Friday, all lenders will increase the prime rate by 25 basis points, which is 0.25%. So 2.45 has now jumped up to 2.7. Okay. What this means is your variable rate mortgage is based on a minus rate. So it would be prime minus 1, for example, just to keep my math round as well too. So yesterday, your interest rate would have been, the effective interest rate would have been 1.45, because it would be 2.45 minus the 1%, giving the effective rate of 1.45. Now that prime has jumped up, we'd be looking at 2.7 minus 1%, given the effective rate of 1.7 to the borrower. This is the way it's calculated for majority of lenders, and then your payment would increase in tandem to offset that difference. There is a particular lender in mainstream lending that, as opposed to increasing your monthly payments, what they would be doing is extending out your amortization schedule.
Okay.
Now, that's something that would keep your payment the same,
Right.
meaning that your cash flow doesn't change, but you might be stuck in that mortgage for up to 99 years, which would be the limit that they'd be able to extend it out to. It's up to the borrower's discretion as if that's the best recourse for them, or if they're comfortable to make the adjustments as prime does increase. And a good school of thought in that would be, if you're looking to do a variable rate mortgage, which is still going to prove effective over a 5-year term currently, you might want to try to set yourself up for a increased payment that's going to be basically paying either the high end of the anticipated increases to prime, or what the fixed rate mortgage is currently. So then that way, you're first and foremost climatized to the payment amount when prime does reaches its peak.
Right.
But in the meanwhile, what you've done is you've contributed more towards your principal, which of course in turn will allow you to shrink your amortization schedule down and also pay less interest as a whole going forward.
Right. Excellent. Now just out of, I'm going to putting up our information where you can reach, wherever it can be reaching you and myself. Just out of a quickie question, by the way, do mortgage lenders want to see a home inspection report, by the way? I meant to ask you this before.
I should say that they don't. Generally speaking, it is a no, unless there is an issue with the appraisal that warrants the necessity to have something inspected a little bit more thoroughly. So perhaps there's maybe some ceiling damage and there's a reported possible leak. The lender spots it, and in that scenario there might be a more thorough inspection required in order to make sure there is no leak, for example. But generally speaking, a lender won't ask for the inspection report. Oh, another thing that might warrant the inspection report to be requested, if by chance an inspection report comes back in favor of a buyer who's able to renegotiate a price to a lower purchase price, the lender will generally ask for the inspection report then, just to make sure there's nothing too out of the ordinary going on to warrant the discount in the price.
Okay, excellent. Listen, I want to thank you very much for sort of coming into this webinar and giving some great answers to some questions I know some of my clients have, and I can go and put this out on the web. I really, really do thank you very much indeed.
Susan, it's my pleasure, and I hope I was of help. Thanks so much for having me on.
Okay, thanks.